Hello students, welcome to E-Pathshala. I am Mrs. P.G. Padmagauri, working as an Assistant Professor, Faculty of Engineering, Avinashlingam University. Today we are going to discuss the module Capital Budgeting. Capital budgeting is a long-term planning for a proposed capital outlays and their financing. Thus, it includes both raising of long-term funds as well as their utilization. It is defined as the firm's regular process for the acquisition and investment capital. Capital budgeting is a many-sided activity. It includes searching for new and more profitable investment proposals, investigating engineering and marketing consideration to predict the consequences of accepting the investment and making economic analysis to determine the profit potential of each investment proposal. Its basic features are: it has the potential of making large anticipated profits. It involves a high degree of risk. It involves a relatively long time period between the initial outlay and anticipated return. Capital budgeting. Capital budgeting defines decision making on investment. It is based on the returns which is proposed investment will give, project implementation process, capital financing, allocation functions, and well-managed company are the part of capital budgeting process. Capital budgeting is the allocation of available funds for capital projects. A capital project is a long-term investment on the tangible assets. The tools and principles capital budgeting is applied in different aspects of a business entity decision making and in security valuation. A company's capital budgeting process is important in valuing a company. Capital budgeting is a project selection exercise done by the business enterprise. Capital budgeting uses the concept of present value to select and implement the projects. Capital budgeting uses tools such as payback period, net present value, internal rate of return, and profitability index to select projects. To evaluate capital budgeting process, their consistency with the goal of shareholder wealth maximization is of utmost importance. Basic principles of capital budgeting. Capital budgeting decisions are taken based on cash flows, not by accounting income. In capital budgeting, the timing of cash flows is crucial. The time value of money is important. In capital budgeting, cash flows are incremental. Cash flows are based on opportunity cost. In capital budgeting, cash flows are after tax basis because cash flows related to taxes is a part of the cash flows that must be analyzed. In capital budgeting, financing costs are ignored in the cash flow analysis. Financing costs enter the decision making through the proper rate of return. Nature of capital budgeting. Nature of capital budgeting is the capital expenditure plans involve a huge investment in fixed assets. Capital expenditure, once approved, represents long-term investment that cannot be reversed or withdrawn without sustaining a loss. Preparation of capital budget plan involves forecasting of several years' profits in advance and judge the profitability of projects. It may be asserted here that decision regarding capital investment should be taken carefully so that the future plans of the company will not be affected. Capital financing and allocation function. The amounts of new funds are needed from investors and lenders. The funds available from internal sources to support new capital projects. These two will determine in the capital financing function. Sources of capital funds. Companies also use outside capital in addition to inside capital. The company in easy capital form increases the company's shares and issuing large amount of common stock from outside. The outside sources of capital include equity partners, stockholders, bondholders, banks and venture capitalists and all whom expect return on investment. Debit capital. Any borrowed money acts as source of capital. It is called as debit capital. The money may be obtained from the sales of bonds or debentures or may be loaned by banks as a line of credit. Equity capital. Equity sources of funding include not only stockholders' capital but also the earnings retained by the company for investment in the business and the cash flow resulting from dissipation charges against income. Procedure of capital budgeting. Capital investment decision in the view of any firm is influence on the entire spectrum of entrepreneurial activities. So, the careful consideration should be regarded to all aspects of financial management. In capital budgeting process, main points to be kept in mind was how much money will be needed for implementing immediate plans, how much money is available for its completion, and how are the available funds are going to be assigned to various capital projects under consideration. The financial policy and risk policy of the management should be clear in mind before proceeding to the capital budgeting process. The following procedure may be adopted in preparing capital budget. Investment proposal for organization. The first step in capital budgeting process is the conception of a profit making idea. The department head collects all the investment proposals and reviews them in the light of financial and risk policies of the organization and send them to the capital expenditure planning committee for consideration. Screening the proposal. Capital expenditure planning committee screens the various proposals within the long range policy framework of the organization. Evaluation of projects. The third step in capital budgeting process is to evaluate the different proposals in terms of the cost of capital, the expected return from alternative investment opportunities and the life of the assets with evaluation techniques. Establishing priorities. The profitable projects or the acceptable projects are then put into priority. Final approval. Proposal finally recommended by the committee are sent to the top management along with the detailed report, but the capital expenditure and of sources of funds to meet them. The management affirms its final seal to proposals taking in the view of the urgency, profitability of the projects and the available financial resources. Projects are then sent to the budget committee for incorporating them in the capital budget. Evaluation. The important step in the capital budgeting process is an evaluation of the program after it has been fully implemented. Budget proposals and the net investment in the projects are compared periodically. Then the budget figures are presented in a more realistic way. Capital budgeting appraisal methods. There are several methods for evaluating and ranking the capital investment proposal. In the case of all the methods, the main emphasis is in the case of all the method, the main is on the return which will be delivered on the capital invested in the project. In the other words, the basic approach is to compare the investment in the project with the benefits derived therefrom. Payback period method, accounting rate of return, net present value, internal rate of return, profitability index. Payback period method is the time duration required to expense the investment committed to a project. In business enterprise, payback period is used as stipulated payback period, which is the standard for screening the project. Payback period calculation. When the cash inflows are constant, the formula for payback period is cash outflow divided by annual cash inflow. Payback period is equal to initial investment divided by annual cash inflow. Example: if a project requires rupees 20,000 as initial investment and it will generate annual cash inflow of rupees 5,000 for 10 years, the payback period will be 4 years as calculated follow. Payback period is equal to initial investment, that is 20,000, divided by annual cash flow, that is 5,000, that is equal to 4. The annual cash flow is calculated by taking into account of net income on account of asset before depreciation but after taxing. Advantages of payback period method. Payback period is easy to understand and apply. Payback period concept is familiar to every decision maker. All the business enterprise facing uncertainty in terms of both of product and technology. So the business enterprises will benefit by the use of payback period method, since the stress in this technique is on early recovery of investment. Enterprises facing technological obsolescence and product obsolescence must prefer payback period method. Enterprise having high liquidity requirements usually prefer this tool, since it involves minimal waitage time for recovery of cash outflows as the empathize recoupment of investment. Disadvantages of payback period method. The value of money in the particular period was ignored. For example, a project X of rupees 500 received at the end of second and third years are given same weightage. A rupee received in the first year and during any other year within the payback period is given same weight, but in practice uncommon knowledge that a rupee received today is higher value than a rupee to be received in future. This drawback can be set it right by using another type of method called discounted payback period method. The discounted payback period method looks at recovery of initial investment after considering the time value of inflows. Investment decision is essentially concerned with the comparison of rate of return promised by a project with the cost of acquiring funds required by the project. Payback period is essentially a time concept. It does not usually consider the rate of return. Accounting rate of return. Accounting rate of return on average rate of return is a financial ratio used in capital budgeting. ARR calculates the return generated from net income of the proposed capital investment. ARR is called as percentage of return. Example: if accounting rate of return, that is ARR, is equal to 7%, then it means that the project is expected to earn yearly 7 rupees out of 100 rupees invested. Accounting rate of return is a rate arrived at by expressing the average annual net profit as given in the income statement as a percentage of total investment or average investment. The accounting rate of return is based on accounting profits. Accounting profits are different from cash flows from a project, and hence in many instances accounting rate of return might not be used as a project evaluation decision. ARR is equal to average accounting profit divided by average investment. Average investment is the sum of the beginning and ending book value of project divided by 2. Advantages of accounting rate of return. The calculation of accounting rate of return is quite simple. Disadvantages. The definition of cash inflow is inaccurate. It takes into account profit after tax only. It fails to present the true return. The time value for money is not considered here. Net present value method, NPV. This is generally considered to be best method for evaluating the capital investment proposal. The NPV is a difference between total present value of future has inflows and the total present value outflows. Net present value of an investment project is a difference between present value of cash inflows and cash outflows. The present value of cash flows are obtained at a discount rate equivalent to the cost of capital. Computation of net present value. Net present value is the difference between the present value of cash inflows and the present value of cash outflows. NPV used in capital budgeting to analyze profitability of the projected investment or project. The following is a formula for calculating NPV. NPV is equal to sigma t is equal to 1 to t C suffix t divided by 1 plus r the whole power t minus C naught, where Ct is equal to total cash inflow during the period t. C naught net initial investment cost, r discount rate, t number of time periods in years. The net present value is positive. It indicates that the projected earnings generated by the project or investment exceeds the anticipated cost. NPV is greater than 0, accept the proposal. If NPV is less than 0, reject the proposal. PV is greater than 0, then accept the proposal. PV is greater than C, accept the proposal. PV is less than C, reject the proposal. PV, present value of cash inflow. C, present value of cash outflow. For example, calculate the net present value for a small size project requiring an initial investment of rupees 20,000 and which provides a net cash flow of rupees 6,000 each year for 6 years. Assume the cost of funds to be 8% per annual. No scrap value. The PV of an annuity of rupees 1 for 6 years at 18% per annual interest is 10% per annual interest is rupees 4.623. Hence, PV of rupees 6,000 comes to 6,000 into 4.623 is equal to 27,738 rupees. We subtracted initial investment 20,000. So, we got net present value 7,738. An investment with a positive NPV will be profitable one, and if with the negative NPV is loss in the capital. Capital asset pricing model. In finance, the capital asset pricing model CAPM is a model used to determine a theoretically appropriate required rate of return of an asset to make decision about adding assets to a well diversified portfolio. Internal rate of return IRR. IRR is that rate at which the sum of discontinued cash inflows equal to the sum of discontinued cash outflows. It can be stated in the form of a ratio as follows: cash inflows divided by cash outflows is equal to 1. Example: sum of rupees 800 invested in a project becomes rupees 1000 at the end of year. The rate of return comes to 25%, calculated as follows: I is equal to R cash inflows divided by 1 plus R. I is equal to cash outflow, R is equal to rate of return yielded by the investment. Thus, 800 is equal to 1000 divided by 1 plus R. So, it gives rate of interest R is equal to 0.25 or 25%. IRR is a rate of return of the company's project generates. Mathematically, IRR can be determined by setting up an NPV equation and solving for a discount rate that makes the NPV is equal to 0. IRR is solved by determining the rate that equates the PV of cash inflows to the PV of cash outflows. Advantages of internal rate of return. IRR number is easy to interpret. Acceptance criteria of IRR are generally consistent with shareholder wealth maximization. Disadvantages: IRR requires knowledge of finance to use. Difficult to calculate, need financial calculator. Capital allocation. Capital allocation for independent projects use the net present worth PW and payback period. If the project's risks are equal, the procedure is to compute the PW for each investment opportunity and then to enumerate all feasible combinations of the projects. Profitability index. It is also known as profit investment ratio PIR and value investment ratio VIR. Profitability index PI is the ratio of payoff to investment of a proposed project. It is used for ranking the projects because it allows you to quantify the amount of value created per unit of investment. To conclude capital budgeting is the important process in which an organization decides whether certain large products such as building an addition or purchasing large equipments are worth the investment for the organization. Usually, the capital is limited amount of it is available in any organization. The critical point of the company leaders is to utilize capital budgeting methods to make the determination which venture or project will bring the company the biggest return on their investment. In the above various capital budget methods like payback period, net present value and internal rate of return are explained. The payback period is the cash flow analysis metric that calculates the length of time for capital acquisitions or investment to play for themselves. It also provides the length of time it takes to cover cost or what is the investment break-even point. Thus, capital budgeting is very much needed for any industry or organization.